You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. I'm Susie.
And I'm Mira. Today is January 14th, 2026. We are looking at Citigroup, fourth quarter 2025.
So Mark Mason signs off as CFO this quarter, and it feels like he decided to take every piece of bad news left in the building and just shove it into this one report.
Yeah, it is the classic exit move. You clear the decks so the new guy looks like a genius next year. The numbers were messy. Earnings per share came in at $1.19. That is down significantly from $1.86 last quarter. Revenue dropped 10% to $19.9 billion. And a huge chunk of that drag came from a $1.2 billion hit just to finally close the book on the Russia business.
Right, the held-for-sale accounting thing, which honestly feels like ripping off a very expensive Band-Aid.
But the market reaction was pretty harsh, though.
Wasn't it?
It was. The stock closed down nearly 5% today. But context matters here. It rallied 16% in the last 3 months leading up to this. So investors were pricing in perfection, and instead they got accounting charges and a confusing bottom line.
Optimism meets a spreadsheet, and the spreadsheet won. And just a quick reminder before we go deeper, none of this is financial advice, just two friends nerding out on numbers. Please do your own homework. But Miro, looking past the mess, there was one narrative shift that really stood out to me.
The services pillar?
Yeah, exactly. For the first time in a while, services revenue was actually significantly higher than markets revenue. Is that the Jane Fraser thesis finally working?
It might be. Services brought in nearly $6 billion. Markets dropped to $4.5 billion. That is boring banking beating the casino. And for Citi, that is a fundamental shift in identity.
All right, let's dig into what those numbers actually mean.
Right. So let's strip it down. Headline revenue came in at $19.9 billion. That is down 10% from the third quarter. And net income, that dropped 34% to $2.5 billion.
34%? That is not a rounding error.
No, but you have to look at why. A massive chunk of that is the Russia business. They took a $1.2 billion pre-tax loss to move that entity to held-for-sale status. Basically, accounting rules force them to recognize all the accumulated currency losses now before the sale even fully closes.
So it really is a kitchen sink quarter. Mark Mason walking out the door saying, I am taking all the trash with me.
Pretty much. It distorts the GAAP numbers, but it leaves the balance sheet cleaner for 2026. But look, the real story, the operating story, is the divergence between the trading floor and the back office. Markets revenue slumped 18% to $4.5 billion. Seasonality played a role, sure, but net income there got cut in half. Meanwhile, services revenue jumped 11% to almost $6 billion.
See, that's the part I find fascinating. We always think of Wall Street as guys screaming at screens, but Citi is basically turning into a massive global utility company. It's plumbing, highly profitable plumbing.
Extremely profitable plumbing. The return on tangible common equity, ROTCE, was 36.1%. You don't get that kind of return in trading unless you are taking massive risks. In services, that is just fee-based, sticky money moving around the world. Assets under custody were up 24%. That validates Fraser's whole thesis.
And expenses? Because that's been the thorn in their side for, well, forever.
They actually controlled it this time. Operating expenses were down 3% to $13.8 billion. And looking ahead, Mason guided for net interest income outside of markets to be up 5 to 6% in 2026. So the engine is humming, even if the paint job looked scratched this quarter.
Okay, so the plumbing is gold-plated, the trading floor is taking a nap, and the outgoing CFO is promising growth next year. But there is a crack in this picture that we need to talk about, because while the plumbing is great, the part of the bank that deals with actual people, wealth, is flashing a warning sign.
Yeah, and wealth and the regulatory timeline. Because fixing the spreadsheet is one thing, fixing the machine itself, that is where things get complicated.
All right, let's zoom in on that, because for all the talk about target states, there is a number in the wealth division that really doesn't fit the narrative.
The number is 61%. Net new investment assets, basically the fresh capital clients decide to park with Citi, collapsed 61% from the third quarter. From $18.6 billion down to just $7.2.
61% in a quarter where the S&P hit all-time highs?
Exactly. That is the massive disconnect. You have a roaring bull market where money should be flooding into wealth management, yet Citi's flows are drying up. Wealth revenue was actually down 1%. It tells me that despite the services win we just talked about, the brand damage on the consumer side is sticky. Wealth is a confidence game. And right now, the wealthy are voting with their feet, or at least leaving their wallets elsewhere.
That's rough. It feels like the one engine that's supposed to be the high-growth story is actually the anchor. But you mentioned the regulatory timeline earlier. Is that what's spooking people, or is that a separate headache?
It is the structural headache underneath everything. Look, on the call, Jane Fraser dropped a very specific stat. She said over 80% of their transformation programs are now at target state.
80% sounds good. I mean, if I finished 80% of a renovation, I'd be popping champagne.
See, that is the trap. In bank speak, target state means we built the new system. It does not mean the regulators have signed off on it. The gap between built and validated is where these turnarounds usually get stuck in the mud.
So it's like they've installed the new wiring, but they haven't called the inspector to see if the house burns down when you flip the switch.
Precisely. And the inspector here is the OCC. Now, to be fair, they did get a win. The OCC removed Article 17 of the consent order in December.
Article 17? That sounds like something from a spy novel. What was it?
Less exciting, unfortunately. It was a specific constraint on their data governance. Getting it lifted is significant. It's the first external concrete proof that the regulators actually see progress. But listening to the management narrative, I noticed a very subtle, very interesting pivot.
Oh, what did they change?
For 2 years, the story has been risk and control, fixing the bank, defense. Now, Fraser is suddenly talking about AI and automation, re-engineering 50 major processes. She's trying to shift the story from repairing to modernizing.
The inevitable AI pivot. I was wondering when that would show up. Don't look at the consent order, look at the algorithm.
It's a bit of that, sure, but it's also risky. Because if you start chasing efficiency gains with AI before you have fully satisfied the regulators on the basic safety and soundness stuff, you might be running before you can walk.
It sounds ambitious. Or maybe just impatient?
I'd say it's necessary survival. They're targeting an efficiency ratio of around 60% for 2026. You don't get there just by cutting travel budgets. You have to automate the heavy lifting. But here's the thing that really changes how I see their strategy.
Yeah?
They are essentially betting that they can finish the fix while launching the future. Most banks do them sequentially. Citi is trying to do both at once because they simply don't have the luxury of time.
That sounds exhausting. And incredibly high stakes for the new CFO coming in.
It is. So yeah, let's step back for a second and think about what all this actually means for the stock going forward.
So where does this leave them heading into 2026?
I think for the first time in this turnaround, the path is actually clear. By taking all that pain now, the Russia charge, the restructuring costs, the new CFO, Gonzalo Luchetti, basically walks into a clean room.
So Mark Mason fell on the grenade, so Luchetti didn't have to.
In a way. And the guidance reflects that freedom. They're projecting net interest income, excluding markets, to be up 5 to 6% in 2026. That is not a survival number, Susie. That is a growth number. It suggests they think the bleeding has stopped.
Which sounds great, but you know me, when I see a clean slate, I immediately look for the cracks they painted over. Did you catch the credit note?
Yeah, the corporate non-accruals. They ticked up by $600 million. Management called it idiosyncratic downgrades, which is banker code for don't look at the trend line, look at the specific bad companies.
Idiosyncratic is my least favorite word in finance. It usually means we didn't see it coming until it was too late.
Fair point. It is a flicker of risk. If that $600 million turns into $2 billion next quarter, then the services profit we celebrated gets eaten up by credit losses. That is the new tension. Can they grow the loan book without growing the default rate?
So it feels like they're finally done fixing the bank, and now they actually have to run it.
Exactly. The construction phase is ending. The operation phase begins. And frankly, the market isn't going to give them any more credit for effort. The next big catalyst is Investor Day on May 7th. That is the moment they have to stop promising a modern bank and actually show us one.
Well, until then, I guess we watch the plumbing and ignore the idiosyncratic leaks.
That's a terrifying metaphor, but yes, let's go with that.
All right, let's close this out.
It was a heavy quarter, but at least the path forward is visible now.
It is. And before we go, I want to take a moment to explain what this project actually is. Earnings Unscripted is an experiment by a small team of enthusiastic people exploring the frontier of AI and how it can be used to enrich us. This episode was created by a team of AI agents, from the research analyst digging through the documents to the scriptwriter, the podcast host, and a fact-checking QA specialist. We are all working together to deliver high-quality, up-to-date information that would hardly be possible otherwise. The goal isn't just to read numbers, but to see if technology can communicate with the same nuance and curiosity as a real conversation. If you have questions or comments or just want to reach out, email us at earningsunscripted@datamadness.ca or follow us on Twitter. We'd love to hear what you think. Thanks for being part of the experiment.
See you after the next call.